This is a nondescript office floor in Chicago's Loop, a few blocks from the old Board of Trade pits. It's here, in 2012, where a former Dow futures floor trader named Michael Patak quietly launched a product he called the Trading Combine. It looked like a software subscription. It was actually the founding document of a multi-billion-dollar industry that, just over a decade later, would collapse into one of the strangest regulatory scandals in modern finance. Patak's story starts the way a lot of trading stories do. He blew up $90,000 across 3 separate accounts early in his career. He rebuilt his discipline using a simulator and then asked a question nobody had really asked before. What if you scouted trading talent the way the NFL scouts athletes? He named his evaluation the Trading Combine for exactly that reason. And quite simply, the modern retail prop firm was born. Now, on paper, the model is elegant. A retail trader pays a fee, usually somewhere between $100 and $500, to take a challenge on a simulated account. Hit a profit target, respect the drawdown, and the firm funds you with up to 6 figures of capital. Pass, and you get to keep 70 to 90% of the profits. In practice, it turns out something much more interesting is happening. 3 years after Top Step launched, 4 university students in Prague named Filip, Tomáš, Marek, and Otakar took those 4 initials, slapped them together, and founded FTMO. They standardized the 2-step evaluation, exported it globally, and by 2024 were doing $329 million in annual revenue with over 1,100 employees. Deloitte named them the fastest-growing tech company in Central Europe. Growth of 39,432% over 4 years. Then COVID hit, and the floodgates opened. Stuck-at-home retail traders, armed with stimulus checks, discovered funded accounts, and Google searches for prop firm exploded over 5,500% between 2020 and 2025. By 2023, more than 2,000 firms were operating worldwide, and the industry was estimated at anywhere from $6 to $20 billion. But here's the part that explains everything that comes next. The funded account is, in almost every case, also a simulation. The firm rarely deploys actual capital into the actual market, which means there's no real P&L, no real broker, and no real trading. Effectively, the firm is the casino, and it's the counterparty to every position. When a trader wins, the firm loses. Except the firm decides what counts as a win. Industry pass rates sit at 5 to 10%. Roughly 7% of traders ever actually receive a payout, which leaves a fairly uncomfortable question. If 90% of fees come from people who fail, and the profits being paid out aren't coming from any real market, then where, structurally, is the payout money coming from? The answer is the next batch of failing traders. This is the Ponzi accusation, and it's not coming from cranks. It's coming from the CFTC, ISMI, Italy's Consob, Belgium's FSMA, and Spain's CNMV. And in August 2023, the CFTC decided to do something about it. They went after the biggest target on the board, MyForexFunds. The complaint alleged $310 million in fees collected from 135,000 customers in over 80 countries. It alleged software-rigged slippage, bot accounts designed to make traders fail, and a Ponzi-like payout structure. It alleged that CEO Murtuza Kazmi had dissipated 31.5 million Canadian dollars to an unknown account. The court froze MFF's assets overnight. Then, in February 2024, MetaQuotes, the company behind the MetaTrader platform every prop firm relied on, started revoking licenses across the industry. The ecosystem collapsed. True Forex funds went under in May 2024, leaving 300 traders holding $1.2 million in unpaid balances. The funded trader froze. Surge trader exited. Between February 2024 and late 2025, 80 to 100 firms simply ceased to exist. But here's where it gets strange. In May 2025, a federal judge dismissed the CFTC's case against MyForexFunds with prejudice. A court-appointed special master, retired federal judge José Linares, found that the CFTC had received an email from the Ontario Securities Commission before filing the lawsuit. That email confirmed the 31.5 million Canadian dollars wasn't dissipation violation at all, it was a tax payment. The agency knew and said nothing for months. The court found the CFTC had acted in willful disregard of the truth, ordered the agency to pay $3.1 million in legal fees to MFF, and 4 CFTC attorneys, plus an investigator, were placed on administrative leave. The regulator became the defendant, which leaves the industry in a deeply weird position. The biggest enforcement action against the prop firm model collapsed not because the model was clean, but because the regulator was sloppy. The structural questions, the simulated funding, the pass rates calibrated for failure, the payouts funded by losers, none of it has been legally resolved. FTMO has tried to outrun the question entirely. In December 2025, it acquired the regulated broker Oanda, financing the deal with a $250 million credit line from Czech banks, though the actual acquisition price was never publicly disclosed, with media estimates landing somewhere between $180 and $220 million. TopStep partnered with Plus 500 and joined the Futures Industry Association. The survivors are dressing in regulated clothing, but beneath the suits, the math hasn't changed. Roughly 93% of traders still fail. Challenge fees still flow in from the bottom and trickle out to the top. The model that one Chicago floor trader invented to scout talent has become an industry where the talent is largely beside the point. What's being sold isn't capital, it's the hope of capital. And as long as that hope keeps generating $100 fees from the next 135,000 customers, the prop firm doesn't really need the markets at all.